Let's get to Lennar, just reporting at the top of the hour as well. Shares of the home builder popping on a Q1 beat. CNBC's Diana Olick joins us now with the details from that quarter. Diana.
Well, that's right, Melissa. Lennar's Q1 beat on the top and bottom lines. EPS came in at $1.96 a share versus estimates of $1.73. Revenue of $7.63 billion versus estimates of $7.43 billion. New orders increased 1% to 8,355. Also above estimates. Deliveries up 6%, right around expectations. Gross margins of 18.7% was just shy of guidance. Now, Lennar's executive chairman, Stuart Miller, noted in the release that the average sale price was down 1% net incentives. He added, our first quarter was marked by a challenging macroeconomic environment for home building. While demand remains strong, persistently higher interest rates and inflation, combined with a downturn in consumer confidence and a limited supply of affordable homes, made it increasingly difficult for consumers to access home ownership. He added that they continue to use incentives, including interest rate buy-downs, to help with affordability. And guidance, though, was right along a little shy of estimates on new deliveries coming in. But again, I spoke with Stuart Miller last week, Melissa, and about tariffs specifically, and he said that was just going to hit affordability even harder. He said it's just hard to get those new buyers in the door, especially those first-time buyers.
The stock just basically took a hit, Diana, just as you were coming to air. So obviously, whatever happened on the conference call, we don't know about that yet. But it is down by 3.25% right now.
Okay, so, conference call's in the morning, I believe.
Tomorrow. Okay,
yes.
That's right. All right. So we'll try and look into this as to the 3% decline here, Diana. Thank you. Diana Olick.
Average closing prices continue to deteriorate. Came in about 408,000. The street was looking for 413-ish, and that continues to decline. Average price for the new order is lower than expected. The backlog is lower than expected, and margins are lower than expected. And that's with rates being favorable over the last couple weeks. I think it speaks to, in my opinion, an economy that's slowing down. And regardless of where rates go at this point, I don't think you want to be in the home builders. We've been saying that for a while.
Yeah, I agree. And the valuations are not the problem. The problem is I think you have to look at the story a little bit differently, both because I think the margins this guy talked about are starting to break down. We know what they've been doing in terms of underwriting some of the mortgage costs. I do think that the consumer is weaker. I think the housing sector was also, if you're an investor, was getting, every time you got some relief on rates, especially back into the fall, it was pushing this up to all-time highs when I thought that story was really something that should have been priced in the first time the Fed started cutting. Even though that was the first time they started cutting, we knew the Fed was going to cut. Markets anticipate that. So you don't need to run into the sector. I actually think home builders are going to be under some water for a couple of years at this point, based upon where we see demand.